portfolio also has not done well. So 1 year to date, I've made hardly 2.5% returns in equities. Warren Buffett always say that if next 5-10 years you're going to invest a lot of money, tons of money, do you really want the markets to go up or go down or remain flat? Because I felt that markets are not cheap. So I thought, let me kind of gather some dry powder also. So for last 3-4 years, I've been gathering this dry powder. Up till first 20% market crash, I will not deploy lump sum. Let my SIPs do the timing. Only when market crashes by 20% or beyond, that is when this dry powder will come handy.
Let's say the next 3, 5, 10, 15 years.
Correct.
What are some of the themes that you personally think that you are very bullish on? And what are some of the mutual funds that you are personally tracking where you feel that you are keeping a close eye or you would like to invest in? Hi guys, welcome to Aspro's podcast once again. And today we have a very special guest with us, none other than Mr. Gajendra Kothari. So, hi Gajendra, welcome to Aspro.
Thank you, Vishwas, for having me here. Excited to share some of my learnings, whatever we have done in this journey.
Now, obviously, you have become a very known face in the last 2 years specifically. You must have done, I think, 60, 70 podcasts. You've been on different channels. People have really connected with your story. And obviously, that story has spread. The story of one idiot, the story of doing the 40-50 lakh SIP that you've been doing, 100% allocation towards mutual funds, and people have really connected with that, right? And obviously you have spoken about this story at multiple podcasts, but today I want to make it a little different. Now that people know your story, right? And a lot has happened also in the last 3 to 6 months in the markets. So today I basically want to have a review of the current market sentiments, current market situations, and based on that, how are you adapting? How is your portfolio looking now? And what are you thinking for, let's say, in the short-term plans and in the long-term plans as well?
Correct.
Right? So at the start, if you can just start with, what do you make of the current market situations? A lot of geopolitical things have happened. The US-Trump situation has happened. So a lot of things are happening.
Correct.
What do you make of it?
Thanks, Vishwas. I think it's a very valid question. So firstly, as a principal, I generally don't go by the narratives. I don't look at the headlines. It doesn't really matter to me personally. I see whatever comes in the headlines, it's reflected in the price, valuations. So I only see the valuations, charts. What are the charts telling me? So of course, last 1 year has been flat or even negative for India. Indexes have not done really well. My portfolio also has not done well. So 1 year to date, I've made hardly 2.5% returns in equities. In fact, that also thanks to China, because I have almost 10% allocation to equities. China has done really well. China has given almost 40% return in the last 1 year.
Right.
And even within China, I had a good amount of money invested in tech fund of China, Hang Seng Tech Fund. That NAV, 1 year NAV has gone up by 100%.
Right.
Okay, so it's crazy.
Yeah.
So I knew in the last 3-4 years when China was not doing well, I was building my position there. I'm almost doing around 5 to 7 lakh rupees SIP in China. And I knew that one day when India will not do well, China will help that recovery. And as we see right now, a lot of FIs, they are kind of taking out money from US, but they're not putting money in India. FIs are pulling out of money from India. A lot of money is going in China.
Right.
So I still feel China has a long runway to go. Still there's a lot more money to be made. So this year China has saved me a bit. Unfortunately, I was not there in gold. I had zero position in gold. For the simple reason, gold this year itself has gone up by 35%. Right. Last year also it was the number one asset class, right? And if you see last 5 years, gold has done reasonably well. It was not like it has come from the bottom.
Yeah.
So I was not convinced. Of course, I missed the rally. There's no point crying right now. So my Indian equities portfolio is flat, though I've added a lot more corpus in the last 1 year through SIPs, like 40 lakhs per month, which I've been doing. So almost like 3.5-4 crores rupees you've added through SIPs in Indian. But someone like me, I really like these kind of markets when you don't make money, because Warren Buffett always say that if next 5-10 years you are going to invest a lot of money, tons of money, do you really want the markets to go up or go down or remain flat? So if markets would have been continuously going up the way it has been going up from 2020 to 24, right? Every time I've been buying at the higher NAVs, right? So in last 4 years, as Kalpin Parekh of DSP says, there is always a bull run. Sometimes the bull run is in the price, which is NAVs. Sometimes the bull run is in the number of units that you acquire. So last 1 year, I am having bull run in the number of units that I acquired through SIPs because I'm buying at a cheaper prices. I, person like me, would want this market to remain sideways or underperform for next 1 to 3 years, so that I'm able to, accumulate sizable number of units, so that when then market goes up, like China, the way I was accumulating China for last 3-4 years. Today, my China returns for the last 3-4 years is showing 30% CAGR. Right, because I've been accumulating at such cheaper prices. So I hope this same happens with my funds which are invested in India.
Understood. Thank you for that sum up. Now, very interesting point you made that even if let's say Indian equities were flat, you made very handsome returns in the Chinese market, right? Now this is particularly what I want to talk about because so one of the narratives that we are sold, especially when retail investors come in for the first time during their first 3 years, what they're sold is, this buy and hold theory works a lot, right? That what we are sold, that buy and hold for the long term. Specifically in the case of stocks, I don't know how much into mutual funds, but in the case of mutual funds also, people are also sold this idea that buy and hold, right? But here you have been diversifying your money as per the valuations, right? Keyword being the valuation here, right? And now, then how do you navigate? How do you sort of decide that I would, let's say, exit from a particular mutual fund and let's say rather invest in somewhere else in a particular ETF or a different market altogether? Because are you making those changes because there are certain investors, specifically retail investors, who might have just bought maybe 4 or 5 mutual funds, a mix of flexi cap, small cap and large cap, and they're thinking that 20-30 years I'm going to continue my SIPs here and then I'll see what kind of returns I've made.
So I have two opinion. One on stock, it can never be buy and hold. You have to buy and then validate every 6 months whether your thesis is right or wrong, right? So in stocks, you have to do a lot of homework even after you have bought the stock. Many people do homework before they buy the stock and then they forget to check, is the company performing in line with what they expected. So it's a full-time job. So though I don't invest any of my money in direct stocks, I really can't comment much. But in mutual funds, Vishwas, you can, for most retail investors, actually they can afford to buy and hold. Even if they are buying and holding a flexi cap fund or a multi-cap fund or an index fund, and if they buy and hold for 10, 20, 30 years, trust me, they'll do very well. Because if they're buying 2 or 3 funds, which has a small cap, mid cap, large cap built into multi-cap, and there's a flexi cap, right? 2 or 3 funds, not more than that. The fund manager at the back is doing the work. The fund manager is switching portfolios. They are churning in and out of the stocks which are not doing well or doing well. And they don't have to pay tax. That's a huge advantage. So if a retail investor keeps doing SIP or lump sum and just give 10-15 years, most of them will end up making anywhere from 12 to 15% return over a 10-year period. But the thing is, very few investors remain invested for 10-12 years, right? So that is why for most retail investors, even for our clients, the strategy that we choose is plain vanilla diversified fund, so that we don't have to do as much churning. Remember, every time we are churning in and out of mutual funds, we are also paying capital gains tax, 12.5% long term plus surcharge and cess, whatever. So you are breaking compounding in some sense or other, right? And again, you have no idea that the fund from where you are switching to the fund where you are going, what is the guarantee that the next fund will perform and this won't perform, right? You may go wrong also. So even for our clients, 80-90% of our investors, we try and prefer buy and hold approach because our promise to them is 12-13% kind of return. We are not promising them moon anyways. But when it comes to my own portfolio, see, I have been into this industry for 21 years. I have seen markets very closely. I interact with market participants. I have a high risk appetite. I don't have life goals coming in the near future. I have unlimited time frame and discipline and patience, and I'm a contrarian. So someone like me also practices buy and hold 90% of the time. On the extreme 5%, when there is a deep buy, like China was a deep buy 2-3 years back, I went and bought China, and at the extreme 5% there will be a sell call also. So China is not a buy and hold for me forever. The day when I see headlines, a lot of people are going to China, returns, last 1 year returns are showing 100% or 2 year returns or 3 year returns. When the whole world is getting into China, I'll exit China and I'll look out for some other opportunities. And for me, entire world is the market. Thanks today in the mutual funds, you can invest in Brazil fund, you can invest in global fund, Japan fund, Taiwan fund, Asia fund, European fund. So for me, the entire world is market, even gold and silver. Tomorrow, so all this while, I've never invested in gold earlier, but now, as a Contrarian, what is my belief? Buy low, sell high. Any asset class that you can get, including real estate. But because I can't buy real estate physical properties, I would never venture into that territory in my life. I don't think I'm capable enough to.
But if there was an ETF or a mutual fund that
precisely, so I was coming there. So the best proxy for me to participate in the real estate is track the realty index,
right,
where Oberoi's of the world, DLF of the world are listed there. Right. If that index has crashed by 50%, I don't mind going and buying that. So you have easy entry and easy exit. So 90% of the time stay invested. 10% of the time when you exit, you should have a very strong reason that you have made a lot of returns. Okay, because you have to pay 12.5% tax also. And at the same time, you have to find another opportunity. Otherwise, what you're going to do with the money? So when all these things are clear, so last year, I after investing for 4.5 years in PSU fund, where I made 56% CAGR returns on SIP, I thought it was crazy, right? People were putting money in PSU and defense. I said, "Abhi sari retail जनता आ रही है, अब मुझे यहाँ से निकलना है." So I encashed and I put my money into banking sector fund, which for last 3 years has not performed. Both calls have gone very right because PSU is down by 20% since the time I have exited, and banking is up by 10%. So I made 30%, and hence I don't mind when I paid that 12.5% tax in the process.
Understood.
But having said that, it's very difficult for a retail investor to do this because you need to do a lot of chart reading, and experience also helps. And that's why professional guidance. And when I take these calls, I just don't take random calls. I first discuss with my team, talk to the fund managers, talk to other colleagues in the industry. When I'm getting then clear good signals from some people who I trust, then I go and take the bet.
Understood. So largely to sum up this is that buy and hold strategy, unlike for stocks, in mutual funds, it can definitely work out.
Yes.
So now building upon this, if let's say whatever time period that is coming now, let's say the next 3, 5, 10, 15 years.
Correct.
What are some of the themes that you personally think that you are very bullish on? Themes as I'm talking about specific industries. It could be EV, it could be AI, it could be something else.
Yes.
It could be manufacturing also. Maybe certain policies that you see by the Indian government that could benefit certain industries within India.
Yes.
And what are some of the mutual funds that you are personally tracking where you feel that you are keeping a close eye or you would like to invest in?
So from a structural theme point of view, I'm very bullish on infrastructure and manufacturing.
Okay.
Personally, it's a long-term thing because if India has to grow at 7% GDP growth and we can't really rely on exports and other things. Right. So you have to create great infrastructure, right? Cities should be connected. So a lot of money, airports. I've been told, I think by end of December. So next month, Mumbai airport is functional. End of December, Delhi airport is functional, the Noida airport. Yeah. Right? So a lot of connectivity will happen, a lot of trade will happen. So infrastructure surely is number one. Secondly is manufacturing. A lot of push from government, a lot of policies are enabling that. And then third is consumption. Okay. Consumption is going to become really big.
Consumption in what sense? Are you talking about the normal retail consumption in terms of FMCG goods, the electronics, the automobile?
Yeah. So yes, broadly that. Even there, we don't have something in mutual funds called premium consumption. Right? It's a part of that consumption basket only. Right? So overall, I believe consumption will do well. Premium consumption will do even better. Right?
There might be many people who might not be able to differentiate between consumption and premium consumption. If you can.
Yeah. Very simple. Like, just to give you an example of biscuits. Right. Britannia, earlier they were all selling 10, 20 rupees biscuits. Now the biscuits are coming 100 rupees, 120 rupees.
So basically that middle class that is moving the higher side, upper middle class and further, they are willing to pay a premium for same kind of products that they used to consume.
Precisely. So yesterday I was hearing a podcast by Prashant Jain. He says, how many people in India own air conditioners? 7%.
Wow.
Only 12% of the people own cars.
Right.
So again, another great example of premiumization is nobody's buying Maruti hatchback these days.
Right.
वो सब खाली पड़ी है. People are going for SUVs.
Yeah.
And within SUVs, look at this. Again, this is very interesting. So suppose you buy a SUV and there's a rooftop, that roof, open roof. That costs another 2 lakh or 1 lakh extra. You will be hardly using once in a year or 3 times a year. But
Right.
you want everything premium right now. You
Yeah.
think that your children will use it every time they go. But people generally don't use. But जब गाड़ी खरीदते हैं तो लगता है अभी खरीद लेते हैं. Let's buy it, you know. So premiumization is going to become big. Even in alcohol, you know, people are looking for aspirational stuff. Even in weddings, look at the kind of weddings now people are doing. They're going to 5-star, 4-star properties
Right.
in Jaipur and other places. So whether are they able to afford it or not, that's another question. But somehow they want to spend today.
Yeah.
The children, the next Gen Z, they want to spend today.
Right.
So I'm very bullish on consumption. Having said that, I always look at the heat map of all the sectors. So like right now, like IT starts to look cheaper because of what happened in
The
Trump.
H1B,
Yeah,
the
H1B.
entire
And for last 2-3 years, IT has not been doing
Yeah.
well. So when I see the heat map, like last year IT underperformed, it was there in the bottom of the sectors. This year it is there. I'll start monitoring actively. And then when it comes to my comfort zone, that okay, now looks this, and when everybody has given up, thrown their towel into it, then I'll go and buy. Because being a contrarian, you know, it's very difficult for your views to match with others. So everybody else would be super negative on IT. When the whole world is super negative on IT, that's a time to buy. See, remember one thing, Vishwas. This doesn't happen in stocks. So suppose if you buy TCS, thinking that okay, it is 50% down. TCS can be a permanent, like Asian Paints, what we are seeing in the last 5 years. Right? If the whole trajectory has changed, if there are 3 new competitors, then Asian Paints will never enjoy the same kind of valuation.
It is for the first time that Asian Paints has not followed its trajectory of almost doubling every 3 to 5 years.
Precisely.
This is for the first time that
because there are 2 more competitors who have come.
Opus has come in.
Opus has come and Birla, you know, Birla Opus is there and you know, few others. So what I believe is, but sectors.
But the paint industry won't. Let's say there was an ETF which was tracking the paint industry, that would still do.
Yes. So sectors rotate.
Right.
Sectors don't die down. खत्म नहीं होते हैं. IT sector खत्म नहीं हो जाएगा. Right. And the beauty in IT sector is also, so suppose TCS is not doing well. Right. TCS will be removed from the IT sector. Somebody else will come up.
Yeah, that's the power of index, that they keep removing the companies which are not wrong. For example, when Satyam thing happened, the Infosys and then the TCS of the world took the charge.
So as a retail investor, my portfolio is diversified.
Right.
I'm not betting on single stocks. I'm betting on a sector. I can have volatility. I will never have permanent risk until I pull the plug. I do redemption. Time can take. So when the first time when I put my money in infrastructure fund, it was, so infrastructure funds had their best time in 2007. And then they crashed in 2008, 9, 10. 2010, they were down almost 50% down. So I thought this is a good entry point. So I met Shankaran Naren, who is a contra investor. So I asked him, sir, अगर आज आपके पास पैसे लगाने को, where would you put your money? He said infrastructure. So I put my money in infrastructure fund. For 10 years, I had nothing. I made no returns. Right? But today, as we speak, my CGR is 14% for last 11 years. So when the boom comes, it comes in 1 year, 2 year, and you make all the shortfall. So you have to have unlimited patience for certain things like infrastructure. For other things like banking or consumption, the cycle changes faster. Right? So, and by the way, if I would have invested in infrastructure stocks of those days, my portfolio would have become zero because all those companies are dead and gone.
Right.
But the fund manager has changed the entire portfolio.
Yeah.
The companies which were darlings of 2007-8, they are all gone.
Right.
These are the new industry leaders in infrastructure segment that has, you know, driven the market.
Absolutely.
So I don't have to apply my knowledge there. And which was identifying sectors or themes or countries is much easier than identifying the stocks, specific stocks.
Right.
It's a very tough job. You have to read independent balance sheets. So it's a very commonsensical thing. Things which have not worked well in 1, 3, 5 years. You should have the courage to buy. That's number one. Then patience to hold for 3, 4, 5 years. Don't expect it to go in 6 months or 12 months. And third and the most important thing, if market further crashes by 50% from those levels, at least that index, do you have the guts to double up?
Right.
If you can't do that, then again you will not really make outsized returns. So in China tech index, when I first invested my 20 lakhs in 2001, within 1 year, I lost 45%.
God.
So my NAV came to 5.5 rupees. Now imagine if I were to ask you, Vishwas, you have also invested 20 lakhs there. Can you invest 40 lakhs now, double up at 5.5 NAV?
Right.
99% people will chicken out,
Right.
saying that boss आधा हो गया portfolio और तुम बोल रहे हो तुमको अभी भी hope है. And that time everything will look even darker,
Right.
right? But I went. So the money that I invested at 5.5 NAV has given me the highest returns.
God.
That investment has given me the fastest returns.
Right.
But it requires a lot of courage. And only when you've seen few cycles and you're a seasoned investor or you're under the guidance of someone and you trust that person, will you be able to do it.
Right.
And you also have to acknowledge that, 1 out of 5 calls may still go wrong.
Yeah, absolutely.
Right? So far I've been lucky that most of these calls have played out. And again, one thing I see when I buy these sectors or themes, people think, यार ये तो बहुत risky में जा रहा है, China जब एकदम खराब था. But think of that way, I'm buying so cheap, my risk reward ratio is actually favorable.
Yeah.
अब यहाँ से नीचे डूबने का chances या तो China पूरा खत्म हो जाएगा, then तो बात ही क्या करना. But if China bounces back, which is happening, so you'll make tons of money. So risk reward ratio, whenever I entered, is highly favorable. To me, world thinks it's very risky.
Yeah. So Gajendra, like you said, that industries or sectors are easier to identify rather than particular stocks. But even within that, I because you also personally believe, and many, even all mutual fund distributors recommend that not keeping more than 4-5 mutual funds or maximally maybe 8 or 10. Now, obviously, if you say let's themes like infrastructure, premium consumption, and if these are the 3 particular themes which are going to work. Then how do you go about selecting the fund managers or the mutual funds there? Because that would be the next piece of the puzzle, right?
One of the reason which I use in my filter is the fund manager should be experienced.
Good.
If the fund manager has 20 years of experience, right, then I would like to bet on that. And if he has a decent track record, I'm not saying he should be chart busters, but because if somebody has 20-25 years experience, they have seen 3 or 4 cycles.
Yeah.
At least they know what mistakes not to make, right? Somebody who has come in just last 3 or 4 years or 5 years, they have not really seen the entire spectrum.
Right.
That is one. Then again, what I believe is once I choose a particular sector or any diversified. So even like last 2 years, I've been betting on quality.
Yeah.
So you have 2 sets of investing: quality versus value. Last 3-4 years, value has done well. So quality has not done well. So I knew that quality is going to do well. So I check with the fund manager, whom I really like, 2-3 fund managers, then check their thesis. And if they are super strong, and if they're seeing net outflows from the scheme, that's a good time.
Yeah.
See, most people end up making mistake. They come with the herd. So if you see right now on social media and everything, one mid-cap fund, particularly from one fund house, is receiving almost 20-25% of the inflows. The fund size has become almost 40,000 crores.
Right.
Because it's number 1 across all time frame. Now this is a very dangerous signal to me, right? So if I have my clients' money in that fund, I will ask them to withdraw, because now it's not that the fund manager is bad, but because the fund manager is receiving so huge inflows, and he's receiving inflows because the fund has delivered very well in the last 1, 3, 5 years, cycles will turn.
So it's a mix of recency bias plus.
Yes, but retail investors always see which is the number 1 performing fund in the last 1-3 years, and they put a lot of money. So a lot of retail investors have put money in one particular fund house, like 3 years back, and today that fund house, all the schemes are at bottom, right? And it's not that they are doing bad; it's a cycle.
It is supposed to be.
It's supposed to be happening, right? Even the best guys in the world underperform for a long time. But retail investors will most time will not make money because they come at the top and they exit at the bottom. And they have a patience window for hardly 6 months, 12 months and stuff like that.
So Gajendra, one thing I think we should discuss more is, so we did discuss premium consumption and infrastructure in detail, but I would like to circle back on manufacturing. What particularly I would like to ask about manufacturing is that India has always had a bad name for manufacturing, that it has always been a complaint that we're not as good as China. We can't produce at that scale, we can't produce at those rates. And so what is the turnaround that you see in Indian manufacturing? Why are you bullish? Like, is it because of the policy? Is it because there is a change that you're seeing at the industry level also, that there is a capital influx coming which can help this industry maybe boom? So what is the entire thesis on that?
Two ways to look at it, Vishwas. One, narrative is strong.
Right.
India needs manufacturing, and whatever we have seen through the tariff episode has even made this topic even more urgent, right? So government of India and even state governments are now vying for companies to come to their states. So I'm sure government is going to do a lot of policy reforms on this front, right? So that looks quite bullish from next 5-10 years point of view. But the second part is, how is the valuations looking like? So valuations are also not cheap. Last 5 years we have seen one-way growth of manufacturing sector. I have my own SIPs going in manufacturing for last 6 years, 2019 till date, and I have earned 22% CAGR on the SIP, which is fabulous. And when I look at my charts, last 5 years on 1 year basis, manufacturing every year has outperformed Nifty 500 index, right? So 5 years is a good indicator that it's not cheap. So I have to be careful now. Okay, it's not expensive or it's not overly expensive, but it's not cheap either. So you have to see, if it becomes suddenly very expensive, then you might have to kind of exit at that amount of time and then come back. So it's not like buy and hold for 10 years. You can do buy and hold also, but then you make maybe whatever 18% return or this thing. But if you can time your exit or entry well, then you can get another 3-4% alpha, because in sectors the movements can happen 20-30% like in 3 months, 6 months. So if your timing gets right, you can really go for those alpha also. But I'm now cautious on manufacturing from valuation point of view. If 1-2 years it really does amazingly well compared to Nifty 500, then I like to kind of cut my position there.
Right. But where did this come from? So is China +1 also playing a big factor in this?
On the narratives front, yes. So, but person like me, I don't give high weightage to narratives or stories. I give higher weightage to valuations. I give higher weightage to what has been the returns, CAGR. It is all reflecting the price. For me, this matters actually, because sometimes you remember 2000 .com peaked, internet arrived, right? But Microsoft, it took 16 years for Microsoft to get to the same stock price. ऐसा नहीं कि Microsoft ने grow नहीं किया था 16 साल में. It grew. It was doing very well. But so much you paid over, this thing. 2000 to 2010, Nasdaq did nothing. At the index level I'm talking about. So you paid huge amount for the index in 2000. So for next 9-10 years you make no return. I don't want to make any mistake on my sectors reading or any such countries reading. So I want to be very cautious about the valuations.
And lastly, what I would like to know is that how is your, the 40-50 CR portfolio that you have right now, how is it structured as of now?
Good question. So as you are aware that I do around 40 lakhs SIP per month. This is all the income that I earn from my business. I don't invest anywhere else, but I earn little higher from that, and that money lies in liquid fund. That money might be used for business expansion or some unknown expenses. So, and because I felt that markets are not cheap, okay, so I thought, let me kind of gather some dry powder also. So for last 3-4 years, I've been gathering this dry powder. Whenever I get any opportunity like China or PSU or any other such thing, then I use that dry powder. So like 6 months back, I put almost 1 CR in China. And luckily in hindsight, that was a great timing, because you made good returns on that. So because the whole world market is open, all other asset classes are open through mutual fund form, I can channelize my money wherever I see an opportunity. So today also 15-16% of my portfolio, almost 10 CR kind of thing, is in cash, which is earning me 7%, right? Which is not bad. Because suppose if 1 year you wait and market crashes by 15%, and then you get an opportunity. So 15 plus 7, 22 you make, right? So you should have 15 to 20%, particularly for someone, any investor who is doing good amount of SIPs anyways. For someone, and then what is my plan, Vishwas? So up till first 20% market crash, I will not deploy lump sum. Let my SIPs do the timing. Only when market crashes by 20% or beyond, that is when this dry powder will come handy. Now this applies very well for me, but there are many investors whom we recommend that if you have a very small amount of SIP that is going per month, you're not making a big meaningful this thing, then after 10% you start looking at, right? Because 20% and higher fall may or may not come. So 10% पे है, और आपने because कम SIP किया, now you put some lump sum, then 15% fall, you add some lump sum. So at least you are averaging well.
Yeah.
So this is a good strategy that we recommend to investors.
Understood.
Yeah.
Understood. I think that's a perfect way to sum it up. But lastly, I would like to touch upon your industry specifically.
Yes.
So apart from the 3 sectors or industries that you mentioned, don't you think even the wealth management industry is really going to explode in the next 15-20 years?
It is, but it is not cheap,
Okay.
So that's otherwise I would love to go very aggressive. In fact, one of the fund houses has launched a capital market index.
Yeah.
Right? So again, I would like to see the valuations. But
Right.
I have a bias towards this. I know very well. The story looks great.
Right.
Looking from my own experience and
Right.
industry experience, I know it has a great long-term story. Tailwinds are there.
Yeah.
But I don't want to overpay it.
Right.
Right? So one thing, let me tell you, if any regulations come or any bad news comes, these sectors crashes by 20-30%.
Yeah.
So why should I hurry? If I can get 30% cheap, it can take 1 year, it can take 2 years, but it will happen. See, markets have 2 things very common. One is volatility.
Yeah.
If markets are not volatile, they're non-markets, they're not equities, then they become fixed deposits, right? And cyclical.
Yeah.
So good times come, bad time come. So you have to just be patient about this. Your time will come. Aapka din aayega.
Right. Right. Thank you so much, Gajendra. I think it was really power-packed, very crisp, very precise, like always. So viewers, do tell us in the comments what you liked about this one. Any specific questions that you might have, we'll get connected with Gajendra and take his opinion as well. So thank you so much. Subscribe to the channel and we'll be bringing more such podcasts. Thank you.
Thank you, Ashwas.